Welcome everyone. My name is Joe. I'm a professional full-time stock trader with 29 years of trading experience, and I'm going to answer some questions now from my Patreon members, 2 or 3 about strategy and a few about individual stocks. And if you are interested in asking me a question, please consider joining my Patreon. Link in the description below, 7-day free trial. And remember, this is not investment advice. It's just for education and entertainment. I'm just sharing my opinion based upon my experience. My first question comes from one of my new members, Gunner, who, wants me to talk more about deep bases. Basically, why are deep bases, I don't know if I want to say bad, but less than ideal, and why they need further consolidation, too much supply, weak holders, etc. And we were talking about it in context of TS. He pointed out TS here, and I pointed out that the base is about 32% deep. So according to O'Neill and Minervini, 2 trading legends, you really want 25%-ish to be the maximum depth in a base. They did studies looking at hundreds of bases, and the ones that were less than 25% deep performed dramatically better than the ones that were deeper than that. We'll talk about why that is in a minute. But first, before we talk about the why, what we really want is nice long bases. The old saying, the longer the base, the wider the base, the farther into space. There we go. And we want a shallow base. This was a spectacular base from NVIDIA, I think 2023, 24, multiple months. And visually, look how shallow it is as it oscillates compared to this base here in TS. And what did it do next? It went from 50 to 150, a triple in I think a year or so. Now, back to the why. So there's 2 reasons. One, all of these buyers over here are potential supply. Some of them unload their shares on the way down, but a lot of them employ hope as a strategy and wait desperately for the stock to go up, and they tell themselves, as soon as I get to break even, I'm getting the heck out of here. So when you've got a deep base like this, as it's working its way up, it's prone to air pockets, sudden dramatic pullbacks as some of these heavy-handed trap buyers unload. Now this, I didn't take the time to find a perfect example of a dangerous deep base. This one is a little less dangerous because you've got a little tight area here for almost 4 weeks, a month. That is essentially a base on its own. And then you've got another nice tight area here, mitigating risk, so to speak. So that's one reason, the trap supply, potential supply. The other thing is when you got a deep base like this, you're going to have swing traders selling on the way up, right? These lucky buyers down here on August 5th, by the time it gets to the top of the cup, they're up 47%. Many of them are going to sell all or at least part of their positions. So the end result is you get something like this. You get a handle that is very long, in this case 44 trading days so far, and deep. This handle is 7% deep. And this probably would still continue going sideways, but this is a steel company, TS, and it's getting a bump from the Trump tariffs that may well move it out. Now, essentially, we've got a new pattern here in the handle, right? Now we've got a double bottom, albeit you want the second bottom to be deeper than the first. This is shallower. This is a short pattern. Short patterns don't generally move as far, but now you've got this is now looking pretty decent, especially if we get a couple inside days here and it starts to drift upward. Now it's a chance to buy. But if you are, trying to buy when the cup completes right here on December 5th, you're in a world of hurt. You probably got shaken out right there. Again, contrast that with NVIDIA. Actually, this is a little bit atypical. Here's our cup, and then here's our handle, and then we had kind of a handle failure. One final shakeout, and then there's our buy point. Let's move on to the next question. Okay, Rick wants to talk about whether I use average true range. Could you explain how you use it? And then wants to talk about UAL. So average true range is just simply an average of the range between the highs and the lows over a series of days. And there are different indicators you can put on your charts. There's debate as to how many days to average together. In answer to your question, I only do it via eyeball, so to speak. After studying thousands of charts, tens of thousands of charts, I really can just eyeball which stocks are what Mark Minervini calls bucking broncos, and which stocks have a pretty mellow average true range. And in general, I avoid the bucking broncos, although in a screaming bull market like spring 2020, those are the ones you like to be in. And I tried to stay in the stocks that have a mellower true range, average true range. And then also you look for stocks that calm down. That's a big thing too. Here's NNE, nanonuclear. This one has definitely been a bucking bronco. If you were looking at some sort of base in this area, you'll notice these wild swings. Here's a 30% day up. Here's a 17% day down. Here's a 8% day down. Here's a 12% day up, etc. Just by looking at this, I know I don't want to get involved in this in a big position, because my average stop is about 5%. And if these things are moving, 5, 10, 15% a day, there's no way I'm going to be able to stay in it. Contrast that with something like Intuitive Surgical. Just look at how much quieter the price action is. See how quiet this drawdown is. See how mellow this uptrend is compared to, something like this or this. Now, obviously, you want to be in this, right? And in hindsight, we could have nailed the spinning top doji, but it's really hard to play a stock with a high average true range. But if you think about it, like right here, it's actually calming down now. We had a 14% move. We had a 12% move. We had a 8% move. The volatility is squeezing out and the volume's coming down. So it might give us an opportunity. That's my thoughts on that. If you, like I say, with any sort of indicator, if it helps you, if you get value out of it, then by all means use it. But personally, I don't use an average true range indicator per se. Okay, UAL now, he posted this 4 days ago. Could you look at United Airlines? Would a possible entry be when it crosses over 110? Okay, here's United Airlines. Airlines in general, I really like that industry right now. It's ranked number 2 out of 200 on Market Surge. A bunch of them are doing well. Delta's doing well. I'm not going to go through the whole list, but trust me. SkyWest doing well. ULCC doing well, etc. And they are poised to continue to do well. Trump is doing his darndest to keep oil prices low, and airplanes burn a lot of gas when they don't have such a high gas expense. They can make more money. So looking at UAL specifically, great earnings numbers last quarter. And we got a nice prior uptrend. We got a few ants there. And then we've got a little double bottom squat. It's just, this is a base on base, right? Here's a base. Here's a base. 110. Yeah. So 2 ways you could play this. Here's 110, right about where I drew that line. So, and there's not a right way of doing this. You can either wait for a breakout above 110, sold off a little bit today, but maybe it comes in a little bit and then breaks out through 110 and you jump on it there. And then you have a, well, hold that thought. Or you buy near the danger zone. See how it came down here and bounced? Came down here, it didn't bounce much, but so you could wait for the next pullback to the 50-day or near the 50-day. And then you don't buy a falling knife, right? But once it starts to bounce back up, then that's where you buy it. So the advantage to buying this breakout, you've cleared all this near-term supply, better chance that it works. Squatted once, but usually, sometimes a stock will squat twice, but usually after one failed breakout reversal, if it rebuilds right away again, usually the next time successful. So better chance of it being successful, but if you buy down here, you got a better entry point. You could put on half a position down here on the bounce and then half a position as it breaks out. Yeah, I definitely would be very comfortable buying it. The breakout at 110 or down there lower, like I said. Relative strength is kind of flatlining. Look for relative strength to break out as well. Companies making tons of money. Good trend on the mutual funds. Wish management owned more. Short interest is not a huge. I also like to make sure there's at least 200,000 shares trading hands, and there's a bunch. All right, next question. Let's see here. Oh, review how the new volume bars on the left side of your screen help your investment decisions. You were going to explain this, but you forgot. Yeah, I totally did. Okay, this is really cool. This is I like to keep my charts simple and clean, and I haven't changed them in quite a while. I made two changes though the last year. One is I overlaid the price action over the S&P 500 so I can see what it's doing in relation to the S&P 500. That's this gray squiggly line. And you have to be, this is on stockcharts.com, and I think you have to have one of the higher priced memberships to do that. But it is right here, volume. No, confuse myself. Under indicators, price, $sign SPX, behind price, and then put the opacity at 0.2. Now, these volume bars, this basically shows the amount. See these bars on the left side? It's going to be hard to articulate this, but I'll try. This basically shows the amount of volume that was occurring during this price area. When you get these, the longer the bar, the more volume of shares were changed hands, and that's what causes supply and resistance. So the most prominent area, this is Intuitive Surgical again, ISRG, was this base here. Tons of shares changed hands here, and the upper end of the range was resistance, etc. And then finally, when it cleared all that supply, that becomes the new ceiling. And now there's no more resistance and it's free to go up. And then oftentimes, if there's a pullback, the institutions will start accumulating in that same level. So this base, the weak hands are selling and the institutions are buying. And so a lot of times the stock will break out and the institution's not done buying, but they don't want to buy, they don't like to buy breakouts and when the stock is extended, because they're buying millions of shares. They buy an extended stock. They're going to extend it much higher. So they wait for a pullback. So a lot of times you'll see a pullback right on top of this bar of volume. Now in this case, the 50-day moving average caught it. Let's just do something here. One thing I like to do sometimes is I will extend these bars, and it just helps me visualize where the supply and resistance is. So I'm going to make this semi-opaque. let's just do this one right here. So there again, so here's your little Darvas box. And what's more, we know that a whole bunch of shares have traded hands. So we know when it gets above this volume bar, there's a good chance it's gonna keep moving higher. And then when it pulls back, we know that it's probably gonna get caught by the institutions are gonna start buying again when it reaches that level. Let's just stretch this one out. Same thing again. So it helps you visualize, especially when you get to an advanced level, you don't really need to draw in all the cups and the handles and the double bottoms and stuff. Mainly you're just looking at where the supply has dried up and when it's coming back down, where the stock might find support. So let's say I'm trapped here in Deckers, DECK. First of all, here was its latest base, and you can see when it clears this area of supply, it really started to move up. Now, the longer the volume bar horizontally, the more powerful it is. And now this thing's crashing, and if you were trapped in this, your best hope now, this is where we saw a ton of buying and selling, this zone right here. So the odds are decent that when it comes down to this zone, about 156, there may be institutions wanting to pick it up at that level. Because another thing is that institutions are often not as technically minded as the retail traders. They're often, they have teams who are figuring out the true value of a stock, and that they want to buy it when it's a good value. And one more time, here's how you set that up. Under overlays, volume by price, I changed the opacity to 0.2 so it's not too intrusive. I think you have to have one of the higher memberships for that, like I said. All right, Karen, I bought, is that Sprouts? No, what is that? It is Sprouts. Bought Sprouts 144 on January 21st. Let me put this on my second screen here, just a second. 144 January 21st, 149 January 27th, 150. Okay, so she did 3 buys, sold the entire position for 11%. I was insecure what to do because of the current volatile market conditions. Originally wanted to hold SFM long term. So I think you did something that we all do. You let the general market action influence your decision on an individual stock. Mark Minervini has said about 1,000 times that we would all do better if we didn't even look at the market indexes and just watched our individual stock. So if your individual stock is doing great, it doesn't matter what the indexes are doing. In fact, if your stock is trending up and the indexes are going down or chopping around, that's a sign that it's really a strong stock and you want to hold a piece. So that's just some general guidelines. Now let's look at this thing. You bought January 21st. Okay, that's a great buy. January 27th, that's a great buy. And January 30th, that, I see you bought kind of the O'Neill breakout. That's extended though. You are wedged up a few days. So I wouldn't have done that last buy. Yeah, I wouldn't have done that last buy. If you did, I would have made it really small with a really tight stop. But this is a classic cheat. This handle's a little low to be a true handle, but this is a great cheat area, decent volume, love the buy. And then this one, January 27th. Yeah, another great buy. You got a demand hammer and then upside reversal there, big volume. Those look great. And then where did you sell it? Oh, February 5th, you sold it. So yeah, it's doing absolutely nothing wrong. You got 10 days up in a row while the market is completely chopping around. Now it's finally resting, but it's resting very tightly. So, one thing you can do in a weaker market is when you hit 10%, just sell a piece, sell a half, sell a third, sell a quarter. This is doing so well. Now it's easy for me to say this because I don't own it, but this is doing so well. I probably wouldn't have sold any of it there. It's not doing anything wrong. It's probably going to, we'll pause out here, and we need the 21-day and the 50-day to catch up. But I would definitely defend my buy point, but I would have let this run. I would have let this run. I mean, look at this price action. This is one of the most powerful stocks in the market this year. And if you would have just used the 50-day moving average as your guide, we could have captured a 270% gain. Maybe it stays above its 50-day for 270% again. So, I don't think you should have sold. You definitely shouldn't have sold all of it, in my opinion. And you could argue you shouldn't have sold any of it until it gets closer to earnings, which is February 20th. Now, listen, I've done the same thing a million times. So don't, I'm just trying to give you constructive feedback. All right, let's see. I think there was, that was actually the last question. Let's just look at the numbers. Sprouts, powerful annual earnings growth, good earnings, decent sales, not amazing. Nice acceleration of earnings, acceleration of sales, gross margin improving. Industry is pretty weak. That's a negative. Casey's is doing well, I think. Natural Grocer, I think, is doing well. BJ's and Costco are doing well. Earnings line going up. Nice trend of mutual funds. Steady numbers. This looks like, this is the kind of stock that can continue going up for months. Look at this. Wow. Nice long. Here's your IPO base there. Buy point, breakout, check back. Here's our perfect buy point right there. And let's look at, I do have a partner, Seeking Alpha. This is where I go for my fundamental analysis. Ooh, up 3% after hours. We could get on here and read some articles. Wait for a better entry point. Buy this aggressive acceleration. Could go back and see what these different analysts have to say. We could read the transcripts on conference calls, etc. There's a link in the description below to Seeking Alpha Premium. All right, that's it. Let me know any of your comments on this, and I will see you in the next video.